My name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. So as I said yesterday, just back from a bit of leave, unfortunately picked up a bit of a cold or whatever, so apologies for the nasally voice. Hopefully it doesn't grate too much. Okay, let's get into today's episode, and it's also all about wholesale investments offered to wholesale investors. And sometimes we get asked about this in terms of, do they get better investment options? And it might sound, impressive and exclusive and so forth. And, sometimes people think, I'm locked out of those markets. And I thought what I'd do is sort of talk about it, set the scene in terms of what are these investments, what do you need to qualify to get these investments, and then share my learnings and insights. Okay, well, firstly, let's start with the definition of a wholesale investor, because you need to be a wholesale investor to access these products. And there's 3 tests that you need to pass according to the Corporations Act to qualify. The first one is a product value test. That is, you're investing $500,000 in one single transaction, $500,000 or more, of course, in one single transaction. That would be pretty uncommon. I mean, it's possible, but it's pretty uncommon. The second test is a wealth test, and that needs to be signed off by a qualified accountant that confirms you either satisfy the net assets test or the income test. The net assets test is that you have at least $2.5 million of net assets, including super and your home. The income test is that you've got a gross income of at least $200,000 per year for the past 2 financial years. And gross income can include any taxable income earned through entities that you control. So if you're self-employed, it's whatever you've got in a company. And so they're pretty easy tests to satisfy, by the way. If you think about how much people's homes are worth and how much equity they have in homes and super, and then plus other investments, not too difficult. The third test, not too difficult for established investors, I should say. The third test is sophisticated investor test. That is, the Australian Financial Services licensee is satisfied that the person has enough experience. They need to provide reasons why they've reached that conclusion, and the client must acknowledge in writing that they have not received disclosure documents and so forth. In practice, this rule's rarely used because the wealth test bar is so low in relative terms, from a wealth perspective. If you don't meet that, I think it's going to be difficult to conclude that that's the case. That you are if you don't have $2.5 million or more than $250,000, it's going to be difficult to confirm that you're not a sophisticated investor unless the investor, has an AFSL license or does those sorts of things. Of course, they fall into that test. Now, these wealth benchmarks were set back in 2001 and haven't been updated since. So they're well and truly out of date in terms of what, protections or what a sophisticated investor looked like almost 25 years ago. And ASIC has actually proposed to the government that these thresholds should be increased. So the income threshold increased from 250 to 450, and the asset benchmark increased from $2.5 to $4.5 million, excluding the family home, which I think makes a lot of sense. There's plenty of people in their 50s and 60s and 70s and beyond that are sitting on a lot of equity in property. If they bought it in the 80s or 90s or something like that, doesn't necessarily make them a sophisticated investor. But surprise, surprise, unfortunately, the government's got no intentions of changing that. Of course, the financial services industry has pretty strong lobbying with the government, and I would only suspect, I don't know, I only suspect that's the reason behind the change, because to me, that change seems like a bit of a no-brainer. So if you qualify as a wholesale investor, what does it actually mean for you as an investor? Well, it just means that you don't have the same protections that a retail investor has. So advisors are not legally required to provide clients with key disclosure documents like a product disclosure statement, a financial services guide, these sorts of things. The statutory best interest duty that applies to retail clients is significantly reduced for wholesale clients, and they cannot access an external dispute resolution body like AFCA, which is an important sort of fallback position if you have some issues, some concerns, or poor advice outcomes. I mean, put simply, it's very much a buyer beware environment. This means the onus is really on the investor to conduct their due diligence, ask the right questions, ensure that they've got all the information required to make a decision. And so from a business perspective, investment product providers and advisory firms are often keen to service wholesale clients just because the compliance burden is a lot lower. But it's really, the way I look at it is, if you're looking at a wholesale investment, everything that you receive in terms of information, I would regard as a sales document. So wholesale investors, I mean, they've got to talk about the risks of an investment and so forth, but it's really, you've got to look at those investments with a healthy level of skepticism, and that requires a lot of due diligence. Now, Pro Solution, for instance, I mean, if I speak about our business, we deal with every client as a retail client. So every client gets treated exactly the same, regardless if they qualify as a wholesale investor. Just means we've got one process, and that process is, very detailed and those sorts of things. But you will find advice firms that focus solely on wholesale investors. And so you just got to understand, that the compliance regime and the oversight and the fallback position in terms of external dispute resolution doesn't have the same, they're on the hook like we are as retail advice providers. So that's something you need to think about really carefully. So now I want to talk about, what are some of the investments that you could access as a wholesale investor, and then I want to talk about some of the potential downsides, upsides, and share some other thoughts. So let's talk about, what investments are available. Well, there's probably 6 or so different sort of categories of investments that are only offered to wholesale investors. So private equity be one, which is investing in established unlisted businesses with the aim of potentially doing an IPO or trade sale, which means a listing on the ASX. So if you think about some of the really successful private equity deals, I probably shouldn't mention it because they are unicorns. There's not too many of them around, but things like Uber, Facebook, these sorts of private equity deals that end up listing on the stock exchanges, and those early investors making, huge returns. Venture capital is backing early stage companies, typically pre-revenue or pre-profit or pre-everything really. Very high risk, but, potential for high return. Private credit is lending directly to businesses outside of the banking system, typically seeking high yields. So you're lending to companies that may not be able to borrow from the major banks or mortgage funds, but of course you'll charge a premium for that as an investor. Infrastructure funds, so large scale assets like toll roads, airports, renewable energy projects, these sorts of things, quite often very capital intensive, but can deliver stable long-term sort of cash flows in terms of income returns. Property syndicates and unlisted property trusts. So that's really, a pool of investors going out and buying a commercial property together, a pool of often unrelated investors going and buying commercial property together. So could give investors access to a price point that they couldn't access on their own. And finally, hedge funds. So unlisted investment vehicles, unlisted managed funds that have a hedge fund is really a fund that has a very broad mandate that can invest across many asset classes and use many strategies, leverage, derivatives, short selling, anything. Their goal really is to generate a positive return regardless of market conditions. So it's really just, here's my money, go and find an asset class or an investment thesis that you believe that you think is going to earn a positive return over the next 12 months. That's the best description of a hedge fund. That can be very high risk, of course. Okay, so let's talk about some of the downsides. Well, firstly, they're higher risk. Many of these sorts of investments carry much higher risk than traditional listed investments. I looked at some research that suggested that only 1 out of 5, so 20% of private equity investments actually achieve their expected returns. But in reality, a lot of them just don't work. And to my mind, the aim of investing is not to maximize risk, but to earn an acceptable return for taking the lowest possible risk. Put differently, maximize the probability of achieving wealth. That's what I want to do, is have a strategy that almost guarantees that I'm going to achieve my goals. And so if you can achieve that by earning a return of, say, 7 to 10% per annum over the long term, your portfolio is going to double every 7 to 10 years. And that, for most people, is more than enough in order for them to achieve their goals. So to my mind, why take such substantial risk? The next downside is illiquidity. Most times there's not a liquid market to sell these investments in, so your capital is usually locked up for a few years. And this inflexibility can be a problem become a problem if your personal circumstances change unexpectedly, and therefore you're then able to access those funds. I remember that we inherited a new client or took on a new client a few years ago that had some of these style of investments, and they weren't performing so great, but we had to wait, for some of them a number of years in order to be able to get our money back and reinvest that capital in a better way. Lack of transparency, listed assets benefit from the price discovery mechanism, daily trading of prices and strict reporting requirements that exist in listed markets, if we're buying share markets, of course. It provides clarity on market value. It tells us what the market thinks about that particular asset, but by contrast, unlisted assets don't have that transparency. Often you don't really know what they're worth until you actually sell them. We can rely on valuers, to go and value property or infrastructure projects or these sorts of things. But that it's not as it's not as concrete as an actual transaction. Also around transparency, related party transactions, conflicts of interest, hidden fees, these sorts of things, always something you need to be mindful of as an investor. Next one is lack of a control. As a minority investor, you typically have no influence on decisions. So great to invest in a startup, but if you've got no control over it, I'm not suggesting you need to have control over it. If you invest in a business that you have no real knowledge of how to run that business, you hope the people in the business know a hell of a lot more than what you know. But the thing is, when things go wrong, that's when investors want to be able to take control and make decisions. But as a minority interest holder, you're not going to be able to do that. And at least with listed assets, if you want to change your mind, you can always put on a sell transaction, and in 3 days, the money will be in your account. As lack of control is a problem. I think that's control is one of the things that I think attracts a lot of investors to property, residential property in particular, because you've got control over the asset, who you rent it to, what you do to it, whether you sell it down the track, all those sorts of things. As opposed to a ETF, you're just long for the ride. But at least if you're long for the ride and you've got liquidity, you can exit if you become uncomfortable. And fees are a lot higher in these style of products as well. Often annual fees range from typically 1% to 2%. So 2% is certainly not unusual. There's other transactional fees. There'll be performance fees involved. Typically, the manager will keep 20% of returns in excess of a certain benchmark. So, and there's many parties involved. So, the fees can compound as well. So they can be more expensive. Now, of course, I should talk about the potential upsides of these products if I'm going to focus. I can't just focus on all the downsides. The potential upside is a huge gain. The whole thing about investing is if you take risk and higher risk, you hope to be compensated for taking that higher risk. Now, we know with these style of investments, because they are high risk, and that's not going to happen every time. But, you hope that if you make 5 investments that, as I said, one's going to work, one will give you a 10 or 20, 100 times gain and will offset the losses against the other 4. So it's really a case of being all in. I think with this sort of strategy, you need to have quite a few fingers in quite a few different pies, knowing that, some of these pies just aren't going to work out. And, at least you're trying to make sure that you're betting on as many options as possible. So at least a couple are going to work out for you. But the attraction obviously is, high returns. Now, apart from returns, the other attraction to wholesale investors, I think, is really around human psychology and a bit of marketing, because labeling something as wholesale kind of creates that level of exclusivity, making investors feel like they're getting kind of an insider deal or, something that not other people can access, and kind of appeals to their ego. It's a bit of a status thing. I'm rich, I'm wealthy, my investments should reflect that fact. I might go to fancy boardrooms, glossy pitch decks, boozy lunches, all those sorts of things, all appeals to that kind of status and that sort of marketing theme. Now, of course, there's going to be examples of very successful wholesale investments, but the truth is, I think much of the industry is more about storytelling than substance. Often what's really being sold is a narrative of exclusivity and superiority rather than, consistently superior returns. And I think that's just something to be really wary of. The other thing I want to call out, included in the introduction in my book, Investopoly, today is I think we really need to be honest with ourselves about what we're doing when we're making financial decisions. And in the book, I talk about that there's really three ways to make money: pure investing, speculation, or business. They're the kind of the three ways, if you like. And sometimes an opportunity is a combination of each of those three approaches, or can be a combination of each of those three approaches. And that's fine, but we just need to be honest with that. So for example, property development, that's more akin or more leaning more towards business than pure investing. But there's a little bit of investing amount in there. Wholesale investing leans a lot more towards speculation than pure investing. This podcast is always about pure investing. I'll be clear about that. I'm not interested in speculation, and this podcast isn't about business. And the reason for that is I just don't, it doesn't align to me personally. We all work hard for our money, and we want our money to work hard for us. And I think most people feel the same way that I do, in that I don't want to lose money, but I'm happy to invest it, of course, and I want to make a good return, enough to achieve my goals, but I don't want to take too much risk with that money. And I think that would describe what most people sort of think about. And so to do that, you need to stick with pure investing. Now, perhaps, and I don't like to quote Warren Buffett too much. I mean, he's kind of overquoted, I think, in a lot of investment contexts. But in this situation, I think it is really appropriate. And I'm going to read a quote by Warren Buffett. And if anyone in the world has opportunities to sophisticated investments or exclusive investments, that are much, much better than the investments that we could access, you would think it's him, right? He's probably at the top of that list. Here's a quote from his 2013 letter to shareholders. And I quote, "My advice to the trustees could not be more simple. Put 10% of cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's. I believe the Trust's long-term results from this policy will be superior to those attained by most investments, whether pension funds, institutions, or individuals who employ high-fee managers." So there you go. He just said put in an S&P fund, IVV, for example, and then 10% in cash. And I think we can take it from that, from someone that has that much wealth, if they're pretty comfortable with that approach, I think it makes a lot of sense for all the reasons that I've spoken about. And I think, ETFs, listed investments, direct residential property, all these sorts of things, they come with a host of advantages that are hard to ignore, particularly ETFs. They're highly liquid. You can buy and sell them anytime. They offer full transparency with daily pricing, strong disclosure requirements. They provide instant diversification, across thousands of companies or bonds or whatever it might be, all at a very low cost, all backed by solid regulatory protections. And most importantly, all have the good ETFs all have a long evidence-based track record of delivering good compounding returns. And what sets them apart is they don't depend on slick marketing or any exclusivity. Instead, they're grounded in logic, rules-based investing, and data. Listed investments might not seem exciting, but building wealth is often boring, and it really should be boring. And that's what I believe where the core of most portfolios should land. But if you want to delve, if you qualify for that and you want to delve in more exciting investments, you could potentially use a core satellite approach, which means your strategy is built based on core investments, and that's what you need to be able to fund retirement. Then if you have excess monies that you want to have a bit of a, in inverted commas, play with, well, then you could maybe look at some high risk investments, knowing that if you lose all the money, it's fine. Your core strategy is working and you're going to achieve your goals. But if you make money, well, then that's a bit of icing on the cake. But I certainly would never develop a core strategy using such high risk investments. So there you go. Sophisticated investors, the answer is no. I don't believe that they have access to better quality investments. They're certainly higher risk. There's certainly a lot of marketing. They're shining objects. But I think most people, virtually all people, and Warren Buffett's included in this, would be well served by taking a more sound, pure investing approach to building wealth. Okay, let's get into some listener questions. First one is from Stefan. Stefan writes, "Thanks very much for everything you do in the podcast. Here's my situation. I'm 37 years old in a government job, earning $108,000 a year plus 15.4% super. I have an investment property in Noosaville that I bought off the plan. Don't hate me. I don't hate you. It's fine. Over the past 2 years it took to build, the value has increased by 30%, which gave me a strong LVR from the start. So that's a good outcome. Now, that brings me to my question. For investing outside super with a 15-year time horizon, would you advocate 100% equities? I know you've suggested that for timeframes of 10 years or more, 100% equities can be optimal if you can handle the volatility. But beyond the framing of an education piece, I haven't heard you explore some other evidence-based approaches that are out there. AQR Capital Management is an evidence-based quantitative hedge fund manager that manages over 100 billion of assets and argues that rather going into 100% equities, a better strategy is to build a safer, more diversified portfolio of equities, bonds, and alternatives, and then use leverage to reach your desired return. They also suggest that if you're all in on equities, it makes sense to split between value and growth, since they tend to perform well in different market conditions. Have you looked into this research? I'd be keen to hear your take on how strategy compares to a 100% equity approach from someone in my position. Well, Stefan, the first thing is that AQR is a hedge fund manager. I don't know them. I haven't looked at their website or anything like that. But as I described in today's episode, quite conveniently, hedge funds can invest in a variety of assets. In fact, that's their kind of promise, if you like. That's their marketing promise, is that they'll consider whatever they think is the best asset. So of course they've got a reason for giving you that answer, is that it's not just all equities, because if a hedge fund just said all equities, then they're not going to be able to compete with other hedge funds that can invest in alternatives and bonds and derivatives and all these sorts of things. So it's a little bit like what Warren Buffett says: don't ask your barber if you need a haircut, because you know what the answer is going to be. Same thing here, I think. Be careful. Every fund manager can give you some positive evidence-based research. In fact, I've never seen a back test. When fund managers back test strategies, even for ETFs or anything like that, they say, well, here's the rules-based strategy and here's what would have happened over the last 30 years. I've never seen a back test that didn't show a great result. Just be careful about what you trust from the product providers, because I'm not saying it's not correct. I'm not saying, anything like that, but just be skeptical about these sorts of things. The thing is, you've got to think about, okay, what is going to achieve the highest return? And my idea around being 100% equities and not having any bonds or any alternative assets is equities have delivered very strong returns over the last 45 years. So if you go back to 1980, it's around about 10%, both in the Aussie market and international index as well. So, that's pretty strong returns, better than alternatives, better than bonds. It's at the highest return. That's why I say that over very long periods of time, 15 plus years, being 100% all in equities is probably going to be the best outcome. Also, as I've spoken about today, some of the risks associated with assets that aren't listed can be much higher as well. So it's a perfect time to answer this question after today's episode. And yeah, so that's my answer, Stefan. I think still 100% equities make sense. Good luck with the property in Noosa. I start to think like maybe it's a good time to maybe take profit over the next couple of years. Maybe hang on to until the Olympic Games. Maybe you'll enjoy some of that positive sentiment. But if you bought something off the plan that's going to be mostly building value, it's not going to work forever. Market sentiment has certainly worked in your favor. And I haven't actually heard about or come across a situation where someone's bought off the plan and the property is significantly more by the time they get to settlement. That doesn't happen that often. So you're very lucky in that regard. But good luck with everything. Okay, next question is from Blair. And, I'll just sort of summarize. Blair did ask a question previously, apparently a couple of weeks ago, which I've answered. And he's asked me to review a ETF portfolio, which I'm happy to do. And I think not only Blair can learn from this, but also a lot of other listeners. Anyway, he's got some share market investments in his self-managed super fund. And this is the way he would like to structure his portfolio. He's going to put 35% in VAS, which is Vanguard Australian Share Fund, ASX 300, 35% in VGS, which is Vanguard International, 15% in VGE, which is Vanguard Emerging Markets, and 15% in VVLU, which is Vanguard Value Fund. And what he's tried to do there is low fees. He's got approximately 20-year time to retirement. trying to avoid the expensive Magnificent Seven stocks and limit US exposure, trying to get access to emerging markets in a cheaper way, and trying to target value a little bit. Because if we think about it, he's got 35% in Aussie and then 65% in international. And of that 65% in international, he's essentially got 54% in just general market cap indexing. He's got 23% in emerging markets and 23% in value. So what he's done is, by putting some away, some in value and some in traditional market cap indexing, is he's diluting the US exposure, and he's diluting the weighting to overvalued companies, which I think makes sense. He's also overweight emerging markets, because normally you wouldn't have more than 5% in emerging markets. He's going to put 15%, which I don't disagree with. I think it's okay. But let me start critiquing it then. Firstly, VAS, I don't have any conceptual problem with VAS, except that from an Australian market perspective, the ASX 300 index is really heavily impacted by and I've spoken about this before, the two miners, Rio and BHP, and the banks. And you might even throw a couple of others, large cap stocks in there, but that's the main thing. So if the banks have a good year, the index has a good year. If the miners have a good year, same thing, but the reverse is true as well. So these companies can have a big impact on the market. Now, if we have a look back to, I don't know when it was, maybe 18 or 19, when the government imposed on the banks what they call a super profits tax, they really had a bad period of time. The market didn't like that, and the banks didn't perform well, and the index was dragged down for that period of time. Now, it's only a short-term sort of performance thing, because the market sort of came to terms with it and recovered. But it really did show me, how the index was impacted there. So I like VAS, but I kind of like QOZ as well, because QOZ is fundamental indexing, so breaking the link with price. So if CBA's profit doesn't change, if its assets don't change, if its cash flow doesn't change, its dividend doesn't change, then our holding in that company shouldn't really change, and that makes sense to me. So investing in the fundamentals. So I might go QOZ, or I might go VAS, or maybe an each way bet on both of those. But that would be my critique of VAS. VGS, it's just general market cap indexing. I'm okay with it, except for the fact that it's got the exposure to those higher sort of overcooked, if you like, technology companies. VGE, I'm happy with VGE, but we have to know that in emerging markets, indexing only beats active managers about 50% of the time. In developed markets, about 80-90% of the time, depending on the time horizon you look over. So indexing doesn't have as good a track record in emerging markets. And the reason for that is that they're just not as transparent as developed markets in terms of disclosure and all these sorts of things. And in a way, the best way I can describe it, in developed markets, it's what you don't invest in that's going to hurt you probably. So instead of finding the stocks to invest in, find the needle in the haystack, just invest in the haystack, which is the index. With emerging markets, it's what you do invest in that's going to hurt you. So that's why index isn't so great, because there's going to be some companies that you definitely want to steer clear of. So active management can work better in emerging markets. And whilst this is not pure active management because it's still rules based, I like EMKT, which is a Van Eck fund that has an overlay, a multi-factor overlay of that includes value, momentum, size, and quality. So they're going to have these filters to filter out those companies that you don't necessarily want to invest in. So I think that's probably, you look at the returns, they're certainly better. More recently, that's probably a better option than VGE. And VVLU, which is Vanguard Value International Value Fund. It's okay. I'm okay with that as well. But I think VLUE is slightly better, which again is another Van Eck fund, because it has a little bit more technology in it. And even that technology is mostly in Europe, or not mostly. There's a greater exposure to technology industry or sector in that value fund, and a lot of those companies are in Europe. rather than the US because it's got a value overlay. Of course, the US ones are, a lot of them are overcooked. But I think I'm not that comfortable with the thesis that technology won't deliver a lot of returns over the coming decade. I think it will. So I don't feel comfortable not having as much exposure because VVLU doesn't have a lot of technology exposure relative to the index, whereas VLUE does. And so I think that they're probably a better option. And so they're just high level comments, not advice, of course. But hopefully it helps people understand that there's a bit more complexity to constructing a portfolio in terms of an ETF portfolio that will have a significant impact on both risk and returns. But that's my day job, so of course I should be able to demonstrate some capacity there. Okay. I think I might leave it there before I lose my voice or it gets too nasally. Sorry about that. And until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.